View of Accounting, Balance Sheet, Chapter 2, Lecture. The balance sheet is the second financial statement you really should get familiar with. And pretty much what a balance sheet does is it tells you what the company owns and how the assets are financed, whether it's financed through a liability or through ownership interest. It gives a picture of the firm at a specific point in time, and it shows what the items are at original cost rather than what the current market value of the assets or liabilities or ownership interests truly are. So here are some balance sheet items to keep in mind. Liquidity. Asset accounts are listed in order of liquidity. What we mean by liquidity is how quickly can you convert these items to cash. So that's another important term to know within finance. Current assets, items that can be converted to cash within 1 year or less. Marketable securities, which are temporary investments of excess cash. Accounts receivable, allowance for bad debt to determine their anticipated collection value. And inventory, which includes raw materials, goods in progress, or finished goods. And those are kind of going from a more liquid basis from current assets all the way to inventory, which is less liquid. Additional items, which include prepaid expenses, investments, and plant and equipment. And these are all just items that, if you've taken accounting courses before, it has them listed there. I'm sure you've learned about these items already in A201 and A202. Total assets is financed through liabilities or stockholders' equity, and it's both of those combined that gives you your total picture and total assets. Liabilities are financial obligations of the firm to move from current liabilities due within 1 year to longer-term obligations. Some short-term obligations include accounts payable, notes payable, accrued expenses. So those are just some examples of shorter-term liabilities, and again, it's just things that are due within 1 year. Stockholders' equity, it represents total contribution and ownership interests of preferred and common stockholders. Preferred stock, that is stock that is put ownership that would get paid first before common stock. Common stock is what traditionally most people purchase when they purchase ownership within a company. It's what's available the most within a company in terms of shares being issued. Capital paid in excess of par, and then retained earnings as well. And this is another example of a balance sheet that the book provided. As you can see, assets and then liability and stockholders' equity combined will equal assets. As you can see, the total assets on here is at $1 million, and the total liability and stockholders' equity is at $1 million. Those should always balance on a balance sheet. That's why it's called a balance sheet. Concept of net worth is important in finance as well, specifically knowing the net worth of a company. Net worth, also known as book value, it's the stockholders' equity minus preferred stock component. So keep that in mind. That could be a test question or maybe a homework question coming up. Market value is primary concern to the financial manager to know how much the company is worth or a project is worth or a department is worth. Security analyst who's looking at a stock to make recommendations whether it's a buy or sell or hold. And then stockholders themselves, if they know how much the company is worth, then is it worth them to still have ownership in it? Or if they're looking at a company, do they want to buy it? Some of the limitations of the balance sheet is most of the values are based on historical original cost price. So it's really things that have already happened in the past. So what could be the market value today is not necessarily what they show on the balance sheet. It's troublesome, especially when it comes to plant and equipment and inventory, because depreciation could have occurred, or they could think that the value of that could be more based on a manager's opinion, and that's kind of some of the limitations with it. FASB ruling on disclosure of inflation adjustments are no longer enforced, so it's purely a voluntary act on the part of the company if they make those adjustments based on inflation. Limitations of the balance sheet. Differences between per share values may be due to the asset valuation, industry outlook, growth prospects, the quality of management, risk return expectations. Could be any of these things. And this shows a comparison of market value to book value per share on this example sheet here. So just showing the ratio of market value to book value, market value per share versus book value. And as you can see, they're a little different on there. And that's end of Chapter 2, Lecture 2. Please see OnCourse for Chapter 2, Lecture 3.